Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Welcome to another episode of the Valmika Property Investing Podcast. Today's episode, we're going to focus on commercial real estate, the basics. I'm going to speak about the types of commercial real estate. Then I'll move on to the advantages of commercial property investments. Then we need to discuss the risks and challenges. Fourth, we will speak about the influencing factors on commercial property values. Then lastly, we'll dive into a case study. So let's get straight to it. Types of commercial real estate. So there's three main categories, so to speak, of commercial real estate. Firstly is the most common one that people see almost on a daily perspective, and that is retail. So retail commercial real estate on high street shops, so that's individual shops that people can invest in, with shopping centers and standalone stores. So by individual shops, I mean you purchase the actual shop as a sectional title, so to speak, and then you will lease it out. So you can have it on a shop-by-shop basis or purchase entire strip mall or a shopping center, for example, when for larger investments. Second category is office spaces. So office spaces such as corporate offices, co-working spaces, and business complexes. The third category is industrial, and this speaks for itself. It's stuff like warehouses, manufacturing facilities, and distribution centers. That at the moment is my most favorite category of commercial real estate. Right, what are the advantages of commercial property investment? So traditionally, commercial property has higher rental yields when compared to residential. This, of late, depending on the area that you're in, especially with regards to residential, might not hold true, but in most cases, commercial property has higher rental yields. And it's a different dynamic, as I've spoken about in a previous podcast. So commercial property is all about cash flow. You don't get the demands for people needing to live in a house like you do in residential. Here, it's all about investment, and it's all got to do with cash flow and the yield. So what I mean by the yield, so that is your yearly rental that you achieve divided by the cost of the property, so that what it costs you to purchase the actual commercial property. The second advantage of commercial property is that there's longer lease terms. So if you look at residential, it's usually 6 months to a year lease that you have, whereas in commercial property it can be several years. I've seen it go as long as 20-year rentals. So they are much longer, they're much more stable. It's just a stable cash flow stream. And if you have a good tenant with a good credit rating, the value of your property increases because the banks that you're getting your debt financing from see it as a stable form of income, and they'll give you a higher gearing on it. But I'll get into that a little bit later. Also, diversification. Commercial properties offer a way to diversify an investment portfolio. So having a mixture between commercial and residential is a good situation to have, because your commercial property usually gives you that extra cash flow to keep you in the game, so to speak, with lower yielding property where the cash flow is probably negative. So having a diversification with a mixture of both commercial and residential is a good investment to have, or purely commercial. What are the risks and challenges when it comes to commercial property investments? They are very sensitive to the market. So commercial properties can be influenced by economic downturns and market fluctuations. When compared to residential property, people need a place to live. So you generally find if the property is near a business hub, like a major city, for example, even in economic downturns, you tend to find that people need a place to live, so it tends to weather the storm. However, commercial property is a little bit different. So if we take the COVID situation, for example, and in particular retail space and office spaces as well. So people weren't going out to shops. They weren't buying at the local shop. So the people who were renting out their commercial property in the form of a retail shop, they weren't able to make their rent at the end of the month because there weren't people coming to buy from them. So it was very sensitive to the market cycle that we were in at the moment at that time. Another example was with office space. So in COVID, people weren't going back to the office. And since then, companies have decided to cut down on the amount of office space they need because people haven't really returned back to the office, particularly in cities like Melbourne, for example. So you find that the office space were very much influenced by that economic cycle that we went through. And this goes, like I said, in cycles. So when you get economic booms, commercial property gets very much in demand because of the strong rental income that comes from there, because businesses are doing well. So the businesses that are renting out the property do well. The vacancy risks when it comes to commercial is also another challenge that you may face. So just like with going back to comparing it with residential property, people need a place to live. So you always find there's this natural demand for people to rent out a residential property. However, with commercial, it's all about finding a business. And for example, if you are in particular got a retail shop, you need to find a suitable business that needs that kind of space. So the demand for the product is less so than when compared to residential in a high demand area, for example. Also, the property management. So this is a third risk. The property management is another risk. Managing commercial property may require specialized skills and resources. So it's very different to dealing with individuals. You're dealing with companies. It might be companies that have trusts, for example, and have protection. So you need to make sure that there is legal accountability when it comes to the property management. And because it's long-term leases, it's very much more involved because the person or the company that is renting out the commercial unit, for example, they're responsible for all the outgoings as well. So we've got to make sure that they're on top of things when it comes to the property management. So it's always advisable to get a commercial property management company to manage it for you. It is worth the fee that you pay because it can come with a lot more headaches. However, having said that, these three risks, if you buy the right commercial property, is something that is very worthwhile having those risks because the returns that you can get in commercial property can be very, very good as well. So what are the factors influencing commercial property values? Just like any property, it's location. So if you've got a commercial property where it's got proximity to business hubs, it's got great accessibility. So for example, if you've got a warehouse and that warehouse has got good accessibility for trucks to get into it, for example, for a lot of parking, easy access to the actual units. For example, you don't have to walk up a large flight of stairs to carry heavy goods, for example. They will have more value on the back of it because it'll attract more more people requiring that product because it has great accessibility. And of course, the local amenities. So for example, if you got a retail store, a shop, and it's in a great strip mall with good cafes, and it's got a Woolworths, for example, if it's got a Coles, Woolworths and Coles always attract a lot of people. So if you've got a retail store that is close to a strong tenant like Coles or Woolworths or Aldi, for example, you'll get a lot more people coming to that strip mall because of that access to those strong tenants. So there's a natural flow to the other retail stores next to it. So local amenities is very important. Economic indicators are very important as well. So at the moment, because of the boom, internet boom, with regards to like Amazon and Kogan, for example, the demand for warehouses is quite high, and it's remained quite high, and the internet economy is growing. So that kind of product is good, and it's great for times where in COVID, for example, when people couldn't get out, and even though the economy slowed down significantly, the increase in internet traffic, internet shopping traffic, increased demand for commercial assets like warehouses. So the economic indicators can influence different commercial property differently. So it's very important to understand this. Give you an example as well. So when you go into an economic downturn, so when it's high interest rates and the economy slowed down significantly, people will cut down on luxury items. And that's usually aimed at retail commercial property because those businesses get influenced by economic downturns. So investing in areas where it's exposed to an economic downturn, you'll have to obviously realize that you'll get tenants that'll be struggling. However, that is opportunity. So if you're looking to purchase a commercial property, purchasing it in a sector that is struggling because the downturn might get you a discounted price, discounted valuations in order to acquire it. And if you've got the view that the economy would turn in the next couple of months, you'll be able to get a cheap commercial property, relatively cheap that is, and be ready for the next economic uptick, and it'll take advantage of that. The lease terms are very important when affecting property value. So if you do not have a consistent long-term lease, for example, if you've got a troubled tenant, if the cash flow streams are not consistent, that will influence the property value because they're all priced off the cash flow from those leases. So if you've got a very strong, very strong tenant that's got a great credit rating, then you might find that their lease values per square meter might be a little bit less because they're better credit, and your yield will be a bit lower. However, you will be able to borrow against that tenant with a higher gearing ratio, depending on your LVR limits that the bank will give you in terms of that. So having a good lease is very, very important. And that will lead us into a case study. I'm going to give you a case study of what we call a bare dominium structure. A bare dominium structure is when you've got a very strong tenant, so a AAA rated tenant, for example. And the example that we have here is there was an insurance company with a good name. I'm not going to give out the names of the insurance company just for confidentiality purposes. However, they required a new building. So we put a structure together whereby it was a 20-year lease. On the back of this lease, we were able to get almost 90% gearing, so 90% debt levels. And we were able to construct the building with only 10% of the value of the asset or the cost of the asset in equity. The rest was in debt. And within the 20-year time frame, the asset will be paid off completely, and we only pay 10% of the value for it. That is the extreme advantages that you get off a very good lease and a good strong lease off a good credit rating. So it's like paying 10% for a large office block because you could get 90% leverage off a very strong tenant. I hope this was valuable, and there was a lot to cover there. But if you would like me to go into more detail in one particular area of commercial property, please drop me a note and I will gladly do that. So moving on to the auctions clearance results for the weekend of the 25th of November. We had a very strong showing in New South Wales, clearance of 67%, with Sydney clearing at 68.7%. So this has been consistent over the last couple of weeks. So there hasn't been much change there, which just shows that the supply is still very low in New South Wales and in particular Sydney. So it doesn't mean that there's a huge demand. It just means that there's a shortage of supply, and the demand that is out there, even though we've got high interest rates, is outstripping the very short supply. So that's what's keeping property prices elevated and continue to increase. In Queensland, still consistent 60% clearance rate, with Brisbane at 61.7%. So the same dynamics apply there, except there's obviously more supply in those areas. Victoria, 63%, with Melbourne clearing at 64%. So a little bit weaker than New South Wales and Sydney. Western Australia, big uptick this week, but it's very volatile because and I say this every week, their auctions work a little bit different to the rest of the states. Most of it is sold outside of auction. But be that as it may, Western Australia cleared at 72%, with Perth clearing at 77%. South Australia is still the strongest state in terms of clearances, auction clearances that is, with South Australia clearing at 74.74% and Adelaide clearing at just under 77%. Well, I look forward to seeing you in the next one, and I hope you enjoyed this episode. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.